That's the story that I think we all know, and it's so easy to get scared out of a position, out of the market. And if you do so, it's so hard to get back in. Hi, I'm Don Drury, president of Moran Wealth Management. And I'm excited to have you join us for our very first inaugural podcast. Really excited to get this off the ground, to be able to share insights, content, highlight a lot of the intellectual capital that really differentiate us, and hopefully share some insight and some thoughts along the way that you'll find of value. And I have Tom Moran. Tom, do you want to introduce yourself? Your name's on the wall. You signed my paycheck.
That it is. I'm glad to sign your paycheck, Don.
I'm glad you do.
Well, I'm CEO, CIO, Moran Wealth Management. Founded the firm over 30 years ago, and I think put together a really talented team of people, professionals that with different areas of expertise. And I think there's a way for us to showcase our talents and the diversity of our team to the public. So I'm very excited about the podcast, the opportunity to help educate people, educate the public on some of the financial topics that we have expertise in.
Well, I was just going to say, it's just not the two of us here. There's somebody else here.
Charlie Chesebrough, head of quantitative strategies.
Thanks, guys. No, I appreciate it. I'm super excited to be here. Thanks for having me. I joined Moran about 5 years ago. I spent my career on the institutional side, looking at markets and following stocks and companies, creating portfolios. And this is new and different because this is people. People have emotions, and all these clients have emotions. It's not cold and calculated and hard. And it's a real enjoyment to sit and talk to these folks and learn where they got their money and where they got their wealth. And importantly, the bond and the trust that you develop with these clients. And credit to you, Tom and Don, for creating such a nice basket of clients that now I get to help talk to and educate and hold their hand when times are rough.
That's the fun part of the business I enjoy the most. So,
gentlemen, I don't know about you, but I got email after email after email. Here's the calendar of events. This is what we're covering. Here's what we're talking about. Here are who the guests are. And I think it changed every day. For the life of me, I don't even know what we're covering today. Do you?
I have a broad outline of the topics, but I've never having done a podcast before, and very excited about the opportunity. But this is so I have no idea what I'm going to say though.
Aren't we talking about cryptocurrency? Isn't that the name?
I don't think.
Tom and I would love to chat about that.
We have
a friendly bet,
friendly lunch bet on crypto. So he's more of a believer than I am.
Yes, well, I'm just a positive guy. I expect good things.
Well, you should attend Charlie's seminar on crypto, and that might you might change your mind. It's
crypto's not everything. Crypto is Bitcoin, and then there's everything else, or Bitcoin and Ethereum and everything else. It's the everything else that
I agree. I mean, it's everyone has their own coin, their own what have you. I think there's clearly something behind Ethereum and blockchain and how it's going to be utilized. And clearly
the stable coin looks interesting.
Yeah. And that's built on Ethereum, right?
I know.
And I would say Bitcoin's done okay so far this year.
You are ahead, and right now I'm hoping you
the year's not over.
Yeah,
you know what the average number of trades a week are in Bitcoin? 8 trades a week on average for Bitcoin
per investor. Is that what you?
Which obviously means some people are doing it 30 times.
Okay,
and some people are doing it once or twice.
Maybe there's a way to gain an edge.
How many cryptos countries out there?
Oh, there's like 9,000 cryptocurrencies.
Cryptocurrencies.
I can make a Tom coin tomorrow.
But I'm
if
sure
I
the-
convince
I
Don to buy
actually
it.
recommend we do that.
Well, I'm sure they're all backed by some fiat currency or some other type of not.
Yeah, not so much.
So, and how much fraud is committed every year in crypto?
Well, I don't even know the answer to that. I know there are numbers out there in the 100 to 200 billion of illegal trafficking of arms, of drugs that are used by cryptocurrency.
Well, but they use, what is it, Monero or something like? Isn't that what?
Isn't that a steak
all the
sauce?
cyber steak sauce? I'm trying to think of what steak sauce you're thinking of. But yeah, I think there's one crypto, and I honestly, I think it's Monero or something that all the cyber criminals use, and that's what they want to get paid in.
Now, the whole basis of crypto is because of the algorithm that it's increasingly more difficult to develop. And so they develop the crypto coin, that it's going to get harder and harder to develop crypto. Now, do you know how fast they think quantum computers, do you know how fast they think they can solve that algorithm?
Well, but there's only, my understanding, there will be a finite amount. And so there's a halving that occurs
Of Bitcoin.
of
Yes.
Bitcoin.
21.6 million or whatever
Exactly. And there'll never be any more.
it is. So that makes it more valuable?
Well, so in Kentucky, we studied something called economics, and there's something called supply and demand. And
Kentucky supplied it.
exactly. So clearly, for people that want something that's not a fiat currency and want that store of wealth, I mean, gold, yes. What can you do with it? You can make a necklace. You can make some sort of jewelry. But you can also make it with some sort of fake-looking gold as well. Is there really any true intrinsic value? No, it's been around forever, and we all associate it as having value. Bitcoin doesn't have that yet, but I think it will. And I recommend we veer the conversation because we shouldn't be talking about Bitcoin.
Well, the answer is 4 minutes. The quantum computer, they estimate, can solve the algorithm for crypto in 4 minutes, which is, right now, it cannot be solved at all. So they better hurry up then.
They could probably figure out my password too then.
I'm getting a little nervous.
Today, we're going to have a little fun. We're going to talk about the second quarter of 2025, what we thought, what actually transpired, and get our prognostication tools out and talk about Q3, the things to consider, those things that are omnipresent, and some of the new variables that have interjected themselves. So, Tom Moran, CEO, CIO, all around great guy, founder. Charlie Chesebrough, CFA, CPA, MBA, head of our quantitative strategies. Gentlemen, welcome.
Thank you.
Thank you. Thanks for having us.
Let's start with where we've been, what we thought would transpire, what actually transpired, and I think that'll allow us to springboard and talk about Q3. And if you want to venture out a little bit, we can talk about Q4. So, Tom?
Well, I can start. It's been a very calm year. Nothing's going on in the world. No wars, no tariffs, no political instability. So really not a lot to talk about in that perspective.
And that's it. Thanks so much for joining us today.
It's been a lot of development. Some things have worked out the way we thought. The market was overvalued and overconcentrated, and there have been some broadening out of the market, and there's been some drop in the PE because we've had a couple good quarters of earnings, and the market hadn't gone up as much as historically average. So the PE's come down a little bit, which is encouraging. The move to value that I thought would be last all year only lasted really about a quarter, and we saw the tech stocks sell off early, but then they have had a great rally back. So they've dominated the last second quarter into the third quarter. So the Magnificent Seven, well, more like the Magnificent Five isn't dead yet now. So that's again, some things, a lot of mixed signals, contradictory signals, but it's encouraging. Like I said, the slowdown seems to be more moderated, not nearly the rapid, deterioration in the economy that we had feared with the tariffs. It seems to be more unevenly paced, but not had the inflation that we thought. So they first, when the tariffs came on, because historically tariffs are inflationary, and then that's been encouraging. And so I'm actually a little more optimistic than I was last year. I mean, going into this year, that we, if we have a recession, and there are some indications with the very weak numbers, consumer sentiment numbers were very weak, and that historically is correlated with recessions. But I think I'm convinced now it's going to be a very mild recession, very maybe very short-lived, if it happens at all. It's really a close call. So a little more optimistic than I was last year. Now going into a difficult, challenging quarter. Third quarter is normally the most challenging quarter, but I think we get through this the next couple of months. I think we could have start to see some significant market improvement, economic improvement going into next 26.
Charlie, do you concur?
Yes and no. I concur that we're going to have a challenging bit of time here coming up because we have not resolved the tariff issues yet. They haven't really gone into effect to the extent that they're being proposed. So I thought by now we may have started to see it really come through in the numbers, and it's still a little early to know what the full impact is gonna be. I think that no matter how we slice it, whether or not it's a recession or it's a slowdown, we're in slowdown. We're going to be kind of sub 1% probably in this coming quarter, and whether or not we actually go negative, I don't know. It almost doesn't matter. Semantics. Things are slowing down. The earnings number for companies for this most recent second quarter were expected to be up 10%, and as the tariff conversation went on, it kept coming down to plus 5% year over year. And now it looks like by what is coming out, and only about 15% of the S&P is reported so far, it looks like it may go back up to 10. So it is a very confusing time where analysts are reducing the estimates because of tariffs. Now they're bringing them back up again, but we haven't seen the full impact of tariffs. So it's going to be an interesting couple of months coming up.
Yeah, I don't disagree actually. I don't think that we can't say tariffs have had. I don't think the jury's still out because I think the first quarter we had imports of people pre-buying things. You buy that car before the tariffs, the refrigerator, and so imports were very higher than normal. And made the GDP number look lower than normal. Well, the second quarter, the opposite. You don't need two refrigerators or two cars, so that amount of imports was way down, and therefore the GDP number was, I think, is going to come in probably 2.5% or so for the second quarter. The third quarter is the rub. That will tell me, how much effect. I'm becoming more convinced it's not going to be as bad as we feared. But it's still unknown exactly what the true effect. As he closes these deals one by one, not the way I would have approached it, but one by one, is slowly getting these countries, and we may see that start to accelerate as we start to get to that. I think there's a deadline sometime in August.
August 1st.
August 1st. So we still have some holdouts, some significant holdouts. Japan, India. Are still EU
kind of all the big ones that really matter. Right?
Other than China, China, and so we'll hopefully he'll get a few more so as remove some of that uncertainty.
Yeah, it's a funny juxtaposition when you think about it. Is here the markets are at all-time highs, NASDAQ, S&P, and tariffs were announced on April 2nd, Tariff Liberation Day. And here are the markets now higher than they were before April 2nd, and yet the tariffs are not resolved. It seems like either the market is completely overlooking it, or maybe they're right and it won't be a big deal. And we are not going to know that for a little while. But
they've had time to digest it, see how some of the iterative process has worked with other countries. So I think while there isn't clarity, there's more clarity than just when it's announced.
True.
Or is the strength of the market, the strength in the growth of the tech stocks, which went down, and now they're having a rally. But what we're not seeing is strength in the mid caps and small caps. They really don't like tariffs, and maybe because they don't have the manufacturing flexibility to move production from one country to another, or to figure tariffs out. But the small caps we have not seen that. They're off from their lows, but they have a long way to go.
That, and also small caps generally borrow more. They have more leverage, and the rate environment is very unknown and very uncertain. And with the debt that we have and everything else, the bias would be up in the long race.
They've come back away from the low, I think, possibly because the interest rates have not gone up, but still at least the value.
They're kind of stubbornly stuck at like 4.5% on a 10-year.
That leads me into something we talked a lot about tariffs. Obviously, the market is more than tariffs. Another big topic that we've all been focused on, heard a lot about, and that's the Fed. Jerome Powell is chatted about from Trump to everyone right now in terms of what should he do, where are we, what's the right decision. So what do you think about Fed policy? How do you think when will the Fed ease, and what's going to happen to Powell?
Surprisingly, I've not been a big fan of Powell long term. I think he was missed the boat on several occasions. But this time he may be right. I mean, I'm going to give him the benefit of the doubt. I think I'm not sure inflation is dead, and if he lowers rates and we have inflation and the economy is slowing, we could be caught in that Japan situation. We have stagflation, and I think that's what the Fed just hates that word. It keeps them they wake up nights screaming because that's the most difficult environment for the Fed to handle. So I'm not opposed to them being a little more cautious. I do think we'll have at least one rate cut by the end. There may be two, but that's the consensus. But I don't think he's going to cut this time. I think he just still wants to see some of that new data come in before he makes, because again, once you get inflation going, it's hard to put that genie back in the bottle.
He does not want to be Arthur Burns from the 70s.
Yeah. So I'll let Charlie
So
comment.
is your call 50? Did I hear 50 basis points by year end? You said 2 rate cuts. Are they 25 each?
25 for sure. I'm not sure 50. Some will depend on how the tariffs come in and how the economy reacts to the economic data, whether you get a second one. But so I'm 1.5 rate cuts. How about that?
And
there is no such thing.
Should we hope for rate cuts? Because that doesn't necessarily bode well.
It has consequences. I mean, the president wants rates at 0 because he's a real estate guy, so they always want rates lower. But they do have consequences. It shows that they're concerned the economy is not growing, and they're going to cut rates. So yeah, I'd be satisfied with 1, but if the economic third quarter, August, September are historically are kind of challenging months. If the economy does slow significantly, maybe into that mild recession, maybe we get 2.
Okay, Charlie, what say you?
I think we get 1 rate cut, and it's not necessarily in September, even though the odds have it for a September rate cut. I think that you'll just start to see the CPI, the PPI, the core PCE numbers. You're going to want to see August come out and then September come out, and a meeting's at the end of September. So there's not a lot of data points between now and then to have these, whatever tariff impact is going to be, to make that kind of a decision yet. I think he's pretty steadfast that he wants to be sure that it's not going to be a problem. And, inflation just ticked up a little bit from the last report that they had. I think he's going to stand pat.
The data's still murky. I mean, we're getting PPI numbers contradict the ISM numbers. We have the payroll contradicts, the job creation. So it's the new jobs. So really jury's not out. Jury's still out about as far as how this economy is going to do.
And don't forget the other part of the mandate, right? It's unemployment. It's the labor force. And we're pretty full employment. I mean, at 4.1, it's not 3.4 that it would hit the lows, but it's still a pretty full labor force that's working. So unless that starts to materially hook up the other direction, he doesn't have that gun to his head. And if you're not getting absolute confirmation about inflation yet, and the labor force is okay, what's the hurry?
Yeah,
Right. Well,
because rates goes up,
things
with the
should
amount
be
of
good.
debt, the debt we have could be very, very detrimental. If with the amount of debt we still have, and rates go up, that's good.
Well, and so help me. Maybe I was not so good at math, but what I don't understand and how the bond market works. Why, if you try and force the short end, Fed, barking at Jerome Powell to lower the rate, why is that going to help the 10-year
No.
and the 30-year where we do all the borrowing for long term?
I don't think you missed that math class because you're right.
Even
that's what he wants.
Even in Kentucky, that math makes sense. So,
So we don't solve the paying interest on the debt problem by lowering the Federal Reserve rate.
No.
all right. So, based on, I think, a consensus here, how should people approach the next 2 quarters? In terms of any material changes in allocation or things to look at or be aware of?
Ooh, the crystal ball question. You go first.
Well, even though this does not international, I've been changing my I've been slowly, marginally increasing my international weighting. I've been dipping into the mids and smalls. I want to be early. I do think you could have a recovery in those by late fourth quarter if hopefully the tariffs are not as bad as we feared. I really don't think they will be, but they could be worse than what they are now. But then once you get a number of these deals cut and settled, I think the small caps will are significantly undervalued, and I think but I'm a patient long-term investor, so short-term it's a harder call. But I think long-term now I'm seeing tremendous value in the mids and small caps that have not participated in this rally. But again, I'm not saying they'll do well in the next couple of months, but I think over the next couple of years they will.
And do you see a change in that large cap Mag 7?
I do.
Do you see that?
I think but it hasn't made it down there yet. It's coming out of the mags. At least I think it will. I think it's moved into the large, but it hasn't made it into the mids and smalls. And that's where I think the real for the growth oriented investor looking for significant returns. That's where the opportunity may be. But it may not. They may have to be a little more patient. They may not come right away. It may be another 3 to 6 months.
Well, that's the smalls, SMID and small. That is the definition of risk on trades.
Yeah.
That's where the money goes when it's risk on. So when we have to get the kind of coast is clear bell to go off on inflation and what the Fed is going to do, and then they're ripe.
Yeah, I might not do it until after September. I've been telling clients that actually had clients that wanted to commit cash. I said, let's just wait a little bit. Let's wait to get through September and maybe the first week of October. That historically is a very good period. I do think those areas are undervalued, have opportunity, but I'm not a market timer. I've been long-term investing, but if I had cash, I probably would not be overly committing that into the more aggressive parts of the market until we get through August and September.
I have a number of clients that have cash, just like the $7 trillion, whatever is that sitting in money market funds out there, wanting to get in and always kind of thinking the correction's coming. When the correction happened in April, then they got scared.
Of course.
That's the story that I think we all know, and it's so easy to get scared out of a position, out of the market. And if you do so, it's so hard to get back in.
Right. Because you're always looking for that negative, that affirming piece that here I was right, the market came back down again.
It goes up. I missed it. I'm not going to get in now, even though it may be just the beginning of a multi-year rally. The market. I've been around a lot of market timers in my career. I've never seen them do it well, ever.
Again, we'll get back to Kentucky. You know, I'm from Kentucky. I can't recall a period where the market's pulled back and we haven't recovered to higher highs. It's a matter of the duration from peak to trough to peak again. And I think it comes down to having liquidity and income if necessary during that period.
And the whole idea of sequence of returns, right? If you need money and you're drawing money and you get a hit like that and you're pulling out money, you may never be able to recover from that. That's why you always ought to have a rainy day bucket, a little cash bucket, so that if we get that downturn, you're not pulling from your equity piece.
How people do the first 5 year retirement is critical, and so that's not my mind. That's not time to add risk. You know, you want to get past the first 5 years and you're ahead of schedule. Then, you want to add. Then I'm all right with adding some risk to the portfolio. But if we do poorly that first 5 years, we're so far behind the eight ball. I mean, it may be, I call critical mass. They're below critical mass, and it may require them to change their lifestyle, and that's what the last thing that we want. We want people to enjoy their retirement.
Okay, I have two parting questions. What is something that's not on the radar that has a probability to present itself between now and year end?
Negative or positive?
Take your pick.
Well, the positive is that we get some of these in the trade negotiations. Some of the bigger ones: EU, India, Japan, Canada, Mexico. We get those in the next 60, 90 days. That would be the upside. The negative would be that we doesn't get these negotiated, and we have retaliatory tariffs, and that would be the and I don't know which way it's going to go. I'm always hopeful, but I can't tell you with certainty that he's going to be able to negotiate these. But those would be two of the biggest variables right now.
Sure.
Yeah, I actually will go a little bit of a different direction there. I think by the end of the year, we're going to have even more clarity on how big AI is going to be, as companies have now been really working hard to integrate it in every part of their business of what the impact on operating margins are going to be. You've now had companies that have very vocally said, we're going to need less people. It's becoming clear, and Amazon has said it, and there'll be more down the road. But I think that will be really important when they have enough clarity to actually maybe change the labor force. And I'm not sure it's going to happen the next 6 months, but I don't think it takes 3 more years from now. And I think you'll start to see some real big changes and switches when that is fully implemented. Not Google and Microsoft that supply a lot of this, but actually more of the Caterpillars and Deeres and Dovers and Eatons and all the companies that just make stuff, how that helps their processes.
Yeah, I have seen that start to pick up. It had a lull there for a while. The May got ahead of itself. But boy, I think the last 6 to 9 days, companies are saying the marginal ways they could be applied that just make them a little bit more efficient. And that means, unfortunately, short term, that means we may have some layoffs.
Yeah, well, I think that's going to be the challenge, right? That's the unemployment rate going up,
So that's my last question for you, and it's interesting you got there. The promise of efficiency that AI brings to an organization, and where that operationally improves margins and all of those important aspects, versus a market that is consumer-led. And so now you have companies that are more efficient, more profitable, better EBITDA, but you have rising unemployment. Where does that net out? Is that net good or is that net bad?
That's a tough one, Tom.
Yeah, short term it's probably bad, but long term, I mean, if we're creating new jobs and new industries, and technology has always been a net positive. I mean, you're looking from the telephone to the iPhone to but the short term, there's been some hiccups and some pain, but and I think the period is getting shorter and shorter. I think the pain will be shorter period than it's and I think the benefit will kick in faster than historically, as the cycle seems to be increasing in speed as new technologies have come over the last century. So it's short term, maybe a little pain, but I think we'll see a significant benefit of competitiveness and new industries and new opportunities for jobs that'll be created over the next year or two.
I agree. I actually talk about this in some of my educational seminars, that this is a productivity story. This is all about productivity. And you think about, going all the way back to the steam engine, to the car, to the radio. And then you get into the personal computer in the 80s, the iPhone in the 90s, where you can be reached at any time, anywhere. Then you had the internet come out in 98, 99, 2000. It took like 10 years to really understand the power and importance to a business of what the internet actually did. I think that time for AI is going to be a whole lot shorter. In fact, it's probably upon us right now. And so in the short term, you're right. It's always disruptive when you have these technology changes. But you think of all those things that were created, we were only better for it.
In my life, I mean, the Zoom or Zoom team meetings has allowed me much more flexibility, and where I'm doing meetings with people, and they feel better because they can contact us. They don't have to be in person meeting, and that's only been really through COVID, and we've only been we've only passed that 3 or 4 years, and how much that's changed our business.
Well, and think about how
for the better.
Think about how that's changed so many businesses in terms of remote work and all of the. It's interesting the spillover effect from some of these things, how broad and how impactful.
I know AI is because my wife claims I missed a 3rd grade grammar class where we put commas and semicolons. So AI has allowed me, saved her so much time having to check my market letters for commas.
Yeah.
I'll tell you, I mean, it really is incredible. I meet with a client, and of course you got to write down the things that were said. Otherwise I'll forget it tomorrow with seeing clients. And you can kind of just get it. It's a little rough. It's a little nasty, and me typing and my typing skills. But I can just load that into a chat or Perplexity and just say, make more profestional.
Right. It doesn't
and
change
bang.
the
No, it's the content. I go back through the content, but it's great.
But it's a time saver, absolutely. Sure. So, and we've added certain new technology. We're adding the new it's the calendar setting. What's it called?
Calendly.
Calendly.
Right. Which is, I mean, I had demonstration of that. That's impressive, and so it's all the new technology we now find we can add to our business to make us more efficient. Gives us more time to spend with our clients.
It certainly allows us and the advisors more time with clients that was originally spent at a desk doing something that wasn't as impactful to a client. And I agree. Well, gentlemen, I think we covered the waterfront. Thank you so much. Thank you for joining us for the first edition of this podcast, and we look forward to seeing you in the future.